I always call it the anti-investment. People don't want to invest. They just want to preserve. And so they put their money in gold.
Gentlemen, this is not the first time that we have talked about the potential for a weakening dollar. And we know that there are also some consequences to gold when you have a weakening dollar. So, Joe, package that together. Tell us kind of where we're at and what you see if you think gold is going to follow the same trend it has in past, or if there's a different direction this time.
Well, I think it helps to think about, why people invest in gold. And I always call it the anti-investment. People don't want to invest. They just want to preserve. And so they put their money in gold. And so we tend to see gold perform well when the economy is weakening. You see real interest rates fall, tends to be a positive for gold. But in general, it is about expectations for economic weakness. And you can see that, 2019 was a year where the economy was weakening. I don't know if you guys remember the Fed was cutting rates that year. Everybody gets thrown off kind of by what happened in 2020, obviously, because you got COVID and you did get a recession. But the yield curve inverted in August of 19. So there was this expectation for economic weakness. And gold did really, really well in 2019. And it obviously continued into 2020 because now you got the realization COVID brought along, hey, it's not just we're expecting weakness, we got it. And so, but then once the economy took off again, people wanted to invest in the real economy. So then from 2020, really the middle of 2020, when it peaked, you didn't break that peak again until really last year. And so the economy was fairly strong in that recovery phase. People want to invest in that. They don't invest in gold. And so, but then starting last year, people started to get this expectation about a weakening economy again. And especially in the summer, you guys remember July and August, there was a lot of talk about, because we did get some weak economic data, and there was a lot of talk about, was the Fed going to cut rates and did they need to cut rates and so forth. And they did end up cutting rates in September and then again 2 more times. So the point is that gold tends to move when there's an expectation of economic weakness. Why is that associated with a weak dollar? Well, because a weak dollar would be associated with economic weakness as well. Now, if it's a dollar index, you're really talking about economic weakness relative to the rest of the world. But in this case, I mean, think about it. The U.S. economy has been kind of the best in the world for a long time. It would be odd, I think. Well, let me say that differently because that's not the way to say it. It wouldn't be odd. It would be unusual, I suppose, based on recent history, for the rest of the world to suddenly outperform the United States economically. But that is indeed what the market seems to be saying here. And by the way, this we really had after the election. It was interesting. I think there was this anticipation that the new administration's policies were going to be positive for growth, and you got gold kind of flatlined there for November and December. But once you got closer to it, and in January, gold took off again. And I think again that is worries that what they're going to do, at least in the short term, is going to cause a weakening of the economy. So that's what's going on. But now that's not the only reason gold moves. I want to highlight something that happened back after 2008. During 2008, that year, gold didn't do all that much. It was down some, and it rallied into the end of the year, but it really didn't go a lot that year, which seems odd because 2008 was this big crisis. You would think people would be buying gold, but they didn't do it. But after 2008, when we started hearing all the talk about QE and we started getting QE, then the gold market took off. And that, in that case, I don't think was necessarily about expectations for economic weakness. It was this idea that QE was money printing and that money printing meant the dollar was going to go down. And gold rallied big time. I mean, from 2000, I gotta get my chart here a little longer because I don't have it going back far enough. Let me go here. Yeah, if you go from 2008, you were $681 an ounce in late 2008. And it started to go up with QE, and it didn't stop until it got to almost 2000, $1,923. And that was in mid 2011. And then at some point, people kind of figured out, and it took a long time, but people figured out that the QE thing wasn't really inflationary. It really wasn't money printing. And by the way, it's not, but it took a while for people to figure that out. And then gold it continued to slide, and it went all the way back down to $1,000 in 2015. actually really kind of beginning of 2016. So that expectation of QE being inflationary turned out to be wrong. Oh, well, I've said many times we watch the market, because the market is the best glimpse of the future you're ever going to get. The market tells you a lot about what people's expectations are in the economy. But this kind of incident just goes to show the market is not always right. It may be the best estimate of the future you're going to get, but it's not going to be infallible. And so I wonder if right now we're getting this surge. Are people buying gold because they fear economic weakness, or are they buying it because they think that the Trump administration wants a weaker dollar? They've talked about that. Maybe that's part of it. Or maybe it is also that they worried that tariffs are going to be inflationary. I'm not sure exactly why people are buying gold. And that's another thing we always say. I don't know what other people are thinking. I can't get inside their head. I can't tell you exactly why they're buying or selling or whatever. And nobody can. But I do find it interesting. What if the Trump administration doesn't devalue the dollar? What if tariffs don't turn out to be all that inflationary because they weren't the first time? Maybe gold is anticipating a future that doesn't come. It's a possibility. Now, having said all that, we actually think the dollar is probably going to go lower. And we have I think, some pretty good reasons for that. I don't believe that. I believe, well, first, I don't have to believe, but we can read. We know that J.D. Vance and a number of others in the administration, including Bissett and also the head of the Council of Economic Advisors, have said essentially that a weaker dollar would solve a lot of problems. And it would solve a lot of problems without causing as much upset as tariffs do. And by the way, that's right. They're absolutely right to some degree. A weak currency cannot solve your trade deficit problem because the trade deficit is actually rooted in the budget deficit, but it certainly can have an impact. Whereas tariffs are not going to fix the trade deficit either, but for different reasons. And in fact, the head of the Council of Economic Advisors, this guy named Morin, he has said in his big manifesto about how to change the global trading system that if other countries retaliate, that tariffs won't work. It's like, well, yeah, we've been saying that. We know that's true. So I think there is maybe an anticipation in the market that they're going to devalue the dollar. And I got to tell you, I kind of agree with it. I think they probably are going to go for that because it is a cleaner way to kind of address their concerns. It's a lot easier than negotiating with I don't know, how many different countries are there in the world? Apparently, they want to try to negotiate a trade deal with every one of them, which seems pretty cumbersome, if you ask me. Devaluing the dollar would be a quick fix. It's not really a fix. It seems like it is, but it's not really. But it would help somewhat with the trade deficit. It would certainly make us more competitive. It also makes us poorer, by the way. This whole idea that all we have to do is devalue our currency and we're going to be more competitive and we're going to win. That's like saying, if I make myself poorer today, it sure will make it easier to make me richer tomorrow. I'm not sure that's really where we want to go. So anyway, I just find gold is a fascinating market because it is just such a weather vane about what people are thinking about the future. And we watch it pretty closely. I will say that I'm a little concerned that gold has gone too far up too fast here. We do think there's probably some kind of transition. If we do get that dollar devaluation, we do think there's some kind of transition into other types of commodities. We're seeing that a little bit now, though we haven't really seen it much with crude oil. We've certainly seen it with natural gas and some other things on the agricultural side and so forth. So interesting topic, Bob. I can't tell you where it's going, but it is interesting. I'll tell you that.
I don't know, Steve. To me, it sounds like trying to devalue your dollar and make yourself poorer is kind of like eating yourself to being skinny.
Yeah, there's some truth to that. Listen, we did a video last week where I said this is not the conspiracy theory you're looking for. I've got one that I do kind of like, and I think we've got an administration here that is looking themselves as a transformational administration, and they're trying to not just redo trade and restructure trade agreements, not just trying to do security and restructure security. I think a good conspiracy is they might try to do a new currency regime. They might try to do a new Bretton Woods, and we've talked a lot about that. Now, I want to kind of go back to some of the stuff Joe was talking about. We don't know. You know, you got to pay attention to markets. Sometimes markets get ahead of themselves and they're wrong. And so that's why you need to actually pay attention to the fundamentals that are going on. And technicals can be a dirty word, but when you use technicals along with fundamentals to kind of get an idea of sometimes the technicals lead the fundamentals. Hey, we got a breakout in gold. What could this mean? And a lot of times you use the technicals to confirm the fundamentals. I've got a thesis. Well, is it actually happening? Now, so I think you got to pay attention to what develops. But yes, we've had gold kind of take off here. And I think you can kind of build a thesis around there that, one of the things it's telling you is, the US is or has been the cleanest dirty shirt. That a lot of countries are running currency regimes that are really depreciating the value of the currency. But since we're all doing it, it's showing up in gold while the U.S. currency has gone relatively strong. But one of the great things about the dollar being so strong right now is, at least from a technical perspective, from a trading perspective, um, I think you've got, limited. I think you can make an argument for putting on a trade here or a position here where it has limited downside and good upside. And a weak dollar bet, I think, gives you that because you're kind of pretty up at fairly high historical norms where if it keeps running, you can say, hey, something's, abnormal here. It's kind of less likely. And there's a lot of downside to that trade or that position. All that said, also, these are things to just have as part of your portfolio. Because sometimes, U.S. stocks aren't always going to be the thing to be in. Sometimes the U.S. dollar isn't always going to, you want some diversification. All that said, I think this is really interesting lineup here to make a bet on the dollar awakening, to make a bet that gold's been leading here and it could broaden out to other commodities. And then pay attention to what develops in the market, what develops in the news, and go in, like Joe said, you can always be wrong. The market will tell you, just listen. If you're running into overweight, back it down to neutral and an underweight if you start getting those signals that you're wrong. But I think there's a really, really interesting argument to be making here that we're at the upper band of the dollar, that there's a lot of downside potential here, that we've got an administration that Joe says is going to look at a weak currency that, as I say, I think looks at itself as transformational. And along with its list of we're going to redo security arrangements, we're going to redo the United States position on the world stage, we're going to redo trade relations. I think they probably got currency on the list too to knock down, maybe on a Tuesday or a Wednesday. I don't know. But I think this could be some interesting times for those markets. So I do think you got to be paying attention to real assets in your portfolio. It should always be there as a diversifier for most folks. And this might be an opportunity for some, interesting opportunities there. And I do think, you can make a strategy based on gold being a leading indicator and this broadening out around some dollar weakness and there being some opportunity in other commodities for the average investor as a minority position in your overall portfolio.
So, Joe, Steve's talked about portfolios. Let's talk about ours for a little bit. In looking at gold and what may happen, because I know we're not trying to predict here, but what is that doing to our management of portfolios right now?
Well, obviously we own gold. We had a full allocation to gold all of last year and the year before as well. We've had a full allocation to gold for a little while here. From a tactical standpoint, usually what we do is we have full allocations and half allocations. We're rarely going to go to zero. We don't do that. We make tactical allocations. A strategic allocation to gold, depending on your risk tolerance, might be 7.5 to 10%. Say it's 10%. So if we're negative on gold, your gold allocation is going to go to 5. Why doesn't it go to 0? Well, because we might be wrong. If you're going to be an investor and you're going to make tactical investments, you better be humble because you're going to be wrong. There's going to be times where you get it right, obviously, and that's great, but there's going to be times when you're wrong too. And when you're wrong, you better not screw it up too bad. So you make incremental changes. But we've had that full allocation for quite a while now, over a year. It's worked very, very well for us, and we're thinking about dialing it back now. We have not really sold any significant amounts. We've had a couple of accounts where we've had to adjust things because it got to be too big a part of the portfolio. But in general, we have not changed our view that we need a full allocation to gold. That's where we are. What we have had is a half allocation to commodities, which we just changed this month. We shifted to a full allocation to commodities because we do believe this broadening out is already happening. We don't think it's prospective. We think it's already happening. I don't know how durable it is. In general, though, what you see is, yes, gold and commodities both respond to a weaker dollar. But which one performs better is going to be dependent on how the economy is doing. If you have a weak dollar, but an economy that's growing fairly rapidly, then general commodities do well. If you have a weak dollar, so the U.S. economy maybe is is seen as less attractive than others outside the United States. But so if you get in a situation where you have a weak currency and weak growth or contraction, an actual recession, then gold will outperform. Right now, I flip a coin. I don't know which way you're going to go. So we do think we have a full allocation to both right now. That's where we are. I suspect we're going to get to a point where we want to back off the gold allocation because if the economy is probably going to stay fairly strong. I don't know that for sure, but that's a guess. I would say too that if you get a weak dollar, but the economy is weak, general commodities, they perform okay, but they don't do great. And there may not be a reason to maintain that full allocation. So that's kind of the way we view things and how we move ahead with things. I do want to address something though that Steve said about a new currency regime. I got to tell you, I think that Stephen Moran, the new head of the Council of Economic Advisors, I know he's got to get approved, but or confirmed or whatever, but that seems like a formality at this point. He wrote a manifesto here. That's really what it is. It's, I don't know, 30 pages, 50 pages, whatever the hell the thing is. I read it. Then I woke up and I read some more. It's typical economic stuff. It's not exactly exciting reading, and he's not exactly an exciting writer. But if you read that, and he's really going to be the head of the Council of Economic Advisors, he's telling you what they want to do. So I kind of take him at his word. So what does he say? He talks about things like currency offset. What does that mean? If you impose a tariff, then if we impose a tariff on another country, the dollar should go up and the other country's currency should go down to offset the impact of the tariff. And he's saying, well, we don't want that. We don't want to have it offset because what's the point then? Same thing with retaliation. He says in this paper, basically, that if there's retaliation, tariffs don't work. So they've got to figure out a way to keep other countries' currencies from going down and a way for them not to retaliate. And here's their plan. Their plan laid out in his paper very clearly is that if you want to be under the U.S. defense umbrella, then you need to let your currency go up and you need to not retaliate. Now, I don't know if that's going to work. I think a lot of countries can be like, I'm sorry, but we don't take orders from you. I don't know how they're going to react, but that's the plan. So you got to take that at face value. I think that's what they're saying they want to do. They want to impose tariffs to get revenue, and they're styling this as a revenue item. They're not, I know that everybody looks at what Trump is doing and saying it's negotiating, it's all these things. I don't think that's it at all. I think it is really that they want the revenue because they want to do other things. They want to be able to give a corporate tax cut. And they think, well, if we get revenue from tariffs, we can cut corporate taxes. Okay, fine. But you've got to get the revenue. And if you don't have a change in things, I mean, you have to get that revenue. It's got to come from somewhere. So they're going to do what they said they're going to do in this paper. I think that's what he's laid out is his vision of how to change things. So they're going to try to devalue the dollar. They're going to try to impose some tariffs to get some revenue, which, by the way, also means that the tariffs can't be too high. Listen, I think people are assuming things here that we don't really know what's going to happen. But if you're going to generate revenue with tariffs, they can't be too high because there's a Laffer curve for tariffs, just like there is for income taxes. If you go above a certain level, suddenly you get less revenue. Well, obviously, we don't want to do that. And by the way, just the fact that, I've heard estimates that maximum, let me think of the right word here, the revenue maximizing point of taxation, that's what the Laffer curve is, that maximum point could be as high as 50% tariffs. Yeah, I don't think it's that high. I think that's insane, actually. Maybe it's 20%, but just because that's the revenue maximizing point does not mean that's where you want to go. Okay, there's going to be unintended consequences to that. So my point is that, look, don't assume that you know what they're going to do, except to look at the thing that they've laid out publicly. The Council of Economic Advisors, the head of the Council of Economic Advisors laid out a blueprint. Well, I just think we got to read the thing, and we have. And so that's part of the reason we expect a weaker dollar is because they've said that's what they want. Again, I'm not sure they can get it, but they're going to try. So listen, I'm a big believer in that when somebody tells you what they're going to do, you should believe them. And so I do. And so we'll just see if we're right. And in the meantime, we're watching everything very closely because all these moves they're talking about, by the way, they make things volatile. So you got to be careful with that. But I think that we'll know if we're getting what we expect.
So there's lots more to come. Keep listening to the podcast and be sure you sign up for our newsletter. There'll be more information there.